9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with Min Lo. We're counting down the open of markets in Greater China. Our top stories this Friday. Asian stocks fall with Korea leading losses as the AI rally stalls. Chip makers bearing the brunt of investors rotating into a broader range of sectors. Hong Kong ramping up scrutiny of mainland Chinese clients, with some banks reportedly halting opening accounts that could be used for overseas investments. And Asian policymakers ramping up currency defenses against elevated energy costs and bets on Fed rate hikes. Indonesia's rupiah under growing pressure as government policies turn investors away. Well, we made it to the end of the week, Min, but it seems like right now there seems to be some cocktail of bad news that's going on here, whether it's a sort of big unwind in some of these chip players in Korea. And of course, we're about to get some big inflation numbers coming through, possibly from the Philippines as well.
Yeah, it's the Philippines. The Kospi actually opened right at the get-go really badly, right? And a lot of it is driven by the extreme volatility because of the highly leveraged ETFs we're seeing in Hong Kong, and a big part of it also, another big risk is a potential BOK rate hike, which could then increase the pressure on margin loans as well.
Yeah, so there's that going on, right? This rotation that seems to be quite fierce here today, and then you pair that with what's going on in the data, right? EMFX continues to be quite under pressure. We're taking a look at some of these Philippine inflation numbers that's just crossing your Bloomberg here right now. Could be better for investors. You take a look at the 6.8% print for May. So this is 1% lower than what the median estimate was for. So perhaps this could be a little bit more of a relief for those that were concerned that the BSP was behind the curve, right? But they have telegraphed before that they might be continuing on with these rate hikes as well, that they, if there is some chance of an off-cycle rate hike, certainly that's one thing that we have been thinking about as well. So we'll see what happens here, but this is obviously seeing a cooling down of prices could be possibly a good sign. But then again, look what happened in Indonesia yesterday. We have RBI with their rate decision coming up as well, set to stay on hold. But then again, anything to commentary around the whole energy crisis will be quite telling for the market.
Yeah, and we are seeing this tumble across EMFX, right? It's not just the Philippines peso, it's not just the Indian rupee, the Indonesian rupiah as well, breaching that 18,000 level yesterday. It could continue to go higher. And you look at the Korean won as well, close to, I think, the weakest levels we had seen since 2009, the Japanese yen as well, and that's a question of whether the BOJ is behind the curve again.
Yeah, so there's more speculation about that. So we're still on intervention watch. You take a look at how risk assets are doing here today. We talked about that slump that you're seeing on the Kospi. So we're down close to 7% in Seoul now and getting ever so close to that 8,000 threshold. S&P futures are in the red here. You're seeing Japan doing badly, but not as bad. But Taiwan coming online, and we are continuing to see red on the screen here today. We're watching the chip space, right? Because it was really what happened with Broadcom. So we saw what happened in the after hours. The U.S. markets were open, and we saw a 13% drop there. After hours continuing as well, that sell-off. So we are continuing to see some of these big chip makers like Samsung and SK Hynix down some 9% here today. Tokyo Electron also down some 7%. So we're going to talk a little bit about that rotation, right? Because today it's not so much the tech sector that's doing well. It's more about the cyclicals and the like. Futures are looking like this in China here today. Perhaps since we're seeing a bit of a sell-off in North Asia, does this give catch-up room for China? Possibly, but we're still seeing futures in the red here today. We're talking about 677, pretty steady for the currency, at least for now, compared to the rest of EMFX here today. Dollar is bid up just slightly. We're still close to 160 levels for Japan. We're seeing still weakness when it comes to the yuan after we did see some, strength after they talked about excessive moves to one side here, and they were ready to act if they needed to. But yeah, the peso certainly will be a focus as markets open up at the bottom of the hour.
Yes, and as the Kospi tumbles and Asian FX goes on intervention watch, let's bring in our Bloomberg Markets reporter, Anthony Stevens. Just talk to us about what we're seeing in Korea and why are the moves so violent today?
Yeah, so it kind of started in the US session, right, with the tech sector falling off a little bit after Broadcom's kind of soft guidance, right? It's important to note that it's about guidance, not about profit. So the kind of parabolic growth you saw in tech slowed a bit, and that money's flowed into financials. So you had the biggest outperformance by financials versus tech in the year. Now, that dynamic is not very helpful to Asia. Our banking sector in the region is not as high a weighting as tech. So you had the region on the back foot from the beginning. Now, Korea is particularly bad because leveraged ETFs have crowded out both the vol market and the cash selling market. So Koreans have been buying cash stocks versus foreigners for a long time, but they're being unable to hedge this because leveraged ETFs have taken up all the hedging space in Korea. Just to run you through the math, if Korean leverage ETF is down, is the market's down 50%, that leverage ETF goes to zero. So their appetite for vol is insatiable.
Yeah, that certainly is one dynamic of how the ETF market is kind of changing things. We have the jobs report coming out from the U.S. If we see another strong number, what does this mean for dollar? What does this mean for EMFX?
Right. Like, we've seen some intervention statistics over the last couple of weeks from India and from Japan. And, they put them together. They've spent more than $100 billion in intervention and gotten absolutely nowhere.
Yeah.
Right. This just shows that the macro is in one direction. You have a strong jobs number. We have them having to look for innovative measures next week. Right. So India is first off the block. They've cut taxes on bond investment. Indonesia and the Philippines have entered a rate cycle. So it looks like Asian FX will have to enter a rate hike cycle to arrest this slide in FX. And that is something that stock investors will be very wary about going in the back end of the year.
Thank you, Anthony Stevens there from our Bloomberg Markets team. We're watching what goes on in some of the financials in Hong Kong, the insurers here this morning, as of course what we saw yesterday here, that was quite a bit of a sell-off on concerns about a report that some banks have suspended opening bank accounts in the city for clients in mainland China. It's the latest reaction to Beijing's unprecedented crackdown on illegal cross-border trading. Let's bring in our chief Malaysia correspondent, Stephen Ingle, on really we continue to see this crackdown, the fallout from it.
Yeah, that's right. I mean, remember, it was on May 27th that Bloomberg had this story about, some compliance checks that are being ordered for wealth accounts across on both sides of the border. Also, those brokerages that the mainland authorities were saying there were some illicit, unlicensed brokerages that were helping facilitate cross-border flows from the mainland into Hong Kong. And again, we've seen the numbers. I mean, we're not implicating any of these banks, but Bank of China, HK, reported a 21% surge in high-end cross-border customers in 2025. HSBC says they saw a roughly 30% increase in Hong Kong customers since January 2023, with two-thirds of them identifying as non-resident HSBC One account customers. Standard Chartered onboarded 275,000 affluent new-to-bank customers globally in 2025, with Hong Kong the biggest market. I'm just rolling out these statistics to show you how much money has been flowing into Hong Kong, and a lot of it allegedly or illicitly has been coming across the border. Chinese authorities are obviously concerned about capital flows at a time of an unstable Chinese domestic economy. Keep in mind, there is a $50,000 limit per person of outbound remittances allowed. But again, a lot of mainland customers have come across the border, or even through banks in mainland, buying insurance policies in Hong Kong. So that's why insurance companies are probably being asked to increase their scrutiny and their compliance. Banks, you mentioned it. Bank of East Asia, according to S&P, Shanghai branch has suspended opening of such accounts, and HSBC, according to S&P, has warned that all funds deposited into investment accounts must comply with Hong Kong regulations. So it's China and Hong Kong regulators in lockstep right now.
So this seems to be an ongoing issue, right? The issue of capital flight. But it seems like Beijing is tightening enforcement right now. How broad do you think Beijing's crackdown is likely to be?
Yeah, I think that's the key question. Because, again, we've been reporting this for a while. And, again, I asked, Iqbal Khan of UBS, the Asia-Pacific Bank chief here, at their conference just a week ago on May 27th. And he said, well, obviously, we have our compliance, it's watertight. It's very robust. But again, he said it's most likely the regulatory crackdown targeting some of the more illicit players, like those specific brokerages. But is it? That's the big question. I'm not saying the banks are doing anything wrong. the question is how far and how deep is the regulatory crackdown going to happen? We know what Beijing wants to stem capital flows, but Hong Kong regulators seem to be moving in lockstep. SFC, the Securities and Futures Commission, has ordered brokerages to audit their clients' onboarding processes after the review exposed document forging, also weak cross-border compliance. And then the Hong Kong Monetary Authority also ordered the closing of investment accounts that were opened with shady documentation or alleged forgery. So, yeah. How deep is this going to go?
We'll see. All right, Steve, thank you. Stephen Ingle there, our chief North Asia correspondent on the latest when it comes to some of the financials here in Hong Kong. Still to come, I'm going to talk to one of the world's foremost authorities when it comes to balance sheet recessions. Yeah, we're talking to Richard Koo, Nomura Research Institute chief economist. He's going to tell us why the Iran war means conventional assumptions no longer seem to apply when it comes to the economy. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show. All right. It is jobs day, of course, in the U.S. today. In terms of what we're expecting, the estimate is for about 88,000 change there in terms of gains in jobs. So certainly, if we see more signs of a strong labor market, what does this mean for this whole kind of rate hike expectations that continue to be increased here, of course, as we deal with the energy shocks around the world? We just saw Philippine inflation, although, less than expected, but still quite punchy in terms of the numbers. So obviously, rate hike expectations continue in the U.S. and across the world here. Joining us now is Richard Koo, chief economist at Nomura Research Institute and widely recognized for his work when it comes to balance sheet recessions and global macroeconomic trends. Richard, it's a pleasure to have you on the show. It's a confusing time, I think, for investors. When I talk about, a fifth of the world's oil supply essentially has been shut, yet oil still remains below $100 and equity markets continue to edge higher in some ways, barring today. Now we see that tech has been consolidating. But how do you make sense of what's really going on now?
I think there's a kind of divergence between what might actually happen and what markets are expecting, in that I think market is expecting that since the midterm election is coming, Donald Trump will make a deal quite soon and oil issues will go away. But my fear is that it's not that easy. And I say this because what kind of deal we are going to get will be affected by the original deal 10 years ago that Obama put together with the Iranians. And at that time, Obama put the whole world on his side to negotiate with Iran, came up with a package, and Iran accepted it. And at that time, there was a goodwill, there was a trust, and Iranian parliament, which had to vote for this thing, voted 161 in favor, 59 against. So even though Revolutionary Guards was bitterly against this agreement, they actually went through it. But now that agreement is gone because Donald Trump took the United States out of it, 2018. The parliamentary situation in Iran, if there is one, I'm afraid that there'll be a lot more hardliners and a lot less moderates to push this new agreement forward. And I think that would make reaching of another agreement much more difficult than it appears on surface.
Richard, Min here. So if we really do not get an imminent agreement, what do you think is the impact going to be, especially on emerging markets?
Well, yes, emerging market is the important one. And Asia in this area is the most important of all, because all that oil that was stuck in, staying behind the Strait of Hormuz are coming in this direction. So United States is self-sufficient in oil. Europe may have other sources, but for Asia, this is a very important issue. I see one positive signs from 2 days ago, and that is that Donald Trump is now telling Israeli Prime Minister to be more moderate or not so bellicose against all the countries around Israel. And I think that's a very big development, because if you look at this whole war, it started with Israeli attack on Iran February 28th. And according to Secretary of State Rubio, United States adjusted its schedule based on that Israeli attack. And so if you are looking at this from the Iranian side, it looks like Israel is the one that's calling the shots, and United States is just following the Israeli leadership. But now Mr. Trump is going strong against Israel to stop the fighting in Lebanon, stop this other aggressions elsewhere. That may start making this negotiation more workable, because Mr. Trump will then have more room to negotiate.
Richard, have we seen enough economic damage yet from both sides, whether it's U.S., whether it's Iran, for both sides to want to at least reopen the Strait of Hormuz?
Well, I haven't been to Iran. I've never been to Iran, so I don't know how much damage Iranians are facing. But of course, this part of the world and U.S., you see inflation numbers going higher, oil prices higher, and so forth. So yes, there's definitely a damage. But so far, all the strategic reserves that were released have kept the situation from really going out of control. But as you know, a lot of countries are running out of strategic reserves, and that might cause problems down the road if this problem is not resolved quickly.
It's
so we may be living on
about
a borrowed time.
Yeah, borrowed time. I was going to ask you about China, because we've seen actually a very steep drop in imports of oil, which some have said has really kind of shielded the world from an energy crisis here right now, and perhaps why oil prices are not above 100 right now. I mean, why do you think we're seeing that? Do you think, is it China tapping into their stockpiles? I mean, what's contributing to this kind of slowdown in imports, you think?
Well, I don't know how much to trust those numbers, but China at least have access to Russian oil. And, all depends on how the deal is made. If you remember, just a year ago, until just about a year ago, China was buying huge quantities of Russian oil at elevated prices, kind of trying to help Mr. Putin. Then they reduced the purchase of Russian oil under U.S. pressure around October, November of last year. But now, with this shortage of oil, I won't be surprised if Chinese were increasing their Russian imports. And some indicators suggest that is actually happening.
We're still seeing at least the U.S. economy seems to be chugging along fine, right? We're waiting the payrolls numbers tomorrow. What is your expectation of the Fed's rate hike outlook?
Well, I'd be surprised if this if Fed is still on the path to lower interest rates. I think that's completely out of the picture. Whether they can actually raise rates, those of us who worked at the central bank, myself included, we all thought that if it's a temporary thing, we don't respond. If it's a long-term thing, of course, we have to respond. And as long as people believe that this is a temporary increase in oil prices and that we're going to have a deal soon, then, of course, Fed will probably stay put. But as negotiations gets longer and more difficult, Mr. Trump said this is going to be over in a few days at the very beginning, then becomes 2 to 3 weeks. And he repeated that 2 to 3 weeks very many times. Now we don't know how long this is going to take. And he's even saying he's in no hurry. And so what that suggests to me is that this may actually be a much longer process. It could get entrenched. And if that happens, of course, the Fed will not want to appear behind the curve.
Yeah, and what's emerged in all this is that the dollar seems to be gaining its king status once again, Richard. I'm talking about dollar yen at 160. Is a rate hike the only way from the BOJ to kind of stem these declines in the yen? Are there other, or do you foresee more intervention from officials there?
Well, intervention is already in the cards, right? And they have been pretty active about that since the Japanese Golden Week holidays 3 or 4 weeks ago. But Japan, the Bank of Japan is really behind the curve on inflation. if you just look at the CPI numbers, they may not appear all that bad. But if you're living in Japan and you go to the supermarket, the food prices are going sky high, 20-30% higher than before. And so that is affecting Japanese living standards, because even though you don't put all your income on food, at least for advanced countries like Japan, it does hurt every day because you have to do the shopping every day. And as a result, that has hurt the Japanese consumer confidence. And it's one of the reasons why the Japanese economy hasn't done as well as it could have done. And that all comes from weak yen. Japan imports huge quantity of foodstuffs from around the world. And so even within Bank of Japan, there are voices, increasing voices, that Bank of Japan is behind the curve. And if you remember, Scott Bessent, the U.S. Treasury, has been saying the Bank of Japan is behind the curve since last year. And so all these forces, I think, are coming together to push Bank of Japan to correct this current situation that it is behind the curve. And it is affecting the Japanese economy in a negative way.
Richard, it's a pleasure to have you on the show. Richard Koo there, Chief Economist at Nomura Research Institute. I just want to recap, of course, the inflation numbers that we got out of the Philippines just a few moments ago. So it was a 6.8% in May. So inflation did ease last month. But we are hearing from officials here talking a little bit more about they recognize that price pressures remain elevated. And here they're looking at continuing targeted measures to stabilize prices. So this is according to the Economic Planning Agency in a statement here this morning. We got plenty more ahead. We're checking, of course, bank stocks here in Hong Kong. The pre-market is doing this right now, extending those declines that we saw yesterday on the back of those cross-border curbs and concerns around the sector. This is Bloomberg. Can you continue to track that sell-off when it comes to some of the bank stocks here in Hong Kong? We saw quite a bit of a drop yesterday here on reports of maybe tighter regulatory scrutiny when it comes to mainland investors opening bank accounts. Here, of course, part of a wider crackdown here when it comes to capital flight and the like here. And actually, we are seeing continued downside when it comes to the likes of HSBC and Stanchart. We're down some 2% or so. Although what you hear from the sell side is that perhaps what we're seeing so far in the market reaction may be a bit overdone. Insurance players continue to see downside as well. Prudential's down some 4% here in the pre-market as well. We'll have the open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting on the open of markets on this Friday, and we continue to see risk assets under a bit of pressure here today. The Kospi certainly is feeling it a lot, just given what we've been seeing with some of these chip makers. So the Broadcom story continues and the fallout there. And then you add what's going on here in Hong Kong with the financials and the steep drops that we saw yesterday on these reports about tighter regulatory scrutiny when it comes to mainland investors opening bank accounts here.
Yeah, so certainly the banking stocks are under pressure here in Hong Kong, but it's a different story in the US, right? We did see the rotation for the history books, really huge rotation out of the tech stocks into some of these banking and financial stocks in the US, and we're seeing some Korean financial stocks also doing pretty well, although their weighting on the index is really not big enough to offset some of the big declines we're seeing in the likes of Samsung and SK Hynix. But take a look at how we are opening on the mainland Chinese markets, and as expected, tracking what we're seeing in the rest of the region. A bit of red here on the screen. We are looking at actually a bit of a bounce when it comes to some of these consumption names, though. Kweichow Moutai and Midea. Even some of the banking names, merchant banks, Ping An Insurance. We have Steve Engel here just now talking about how that mainland Chinese government scrutiny over these outbound investments by individual investors. So far, it doesn't seem to be making a dent on some of these onshore banks and insurance companies. The offshore banks, though, are quite badly hit. But you take a look at Shanghai crude, for example, we are seeing a bit of relief coming through. It seems like markets continue to be hooked on this idea that we might be close to that truce between Iran and the U.S., even though we're seeing these resumption of sporadic fighting and Hezbollah not really agreeing to that ceasefire that was declared by the U.S., right? The ceasefire between Lebanon and Israel. You take a look at Capricorn as well, down by 1.6%, tracking again what we saw in Korea and Japan when it comes to the chips sell-off. You flip the board and take a look at Hong Kong and what's happening there. And yes, we are seeing again a bit of a rebound here when it comes to some of these big tech names, right? The large caps here, Tencent, Baidu, Alibaba, doing fairly well. So quite a bifurcation if you compare what's happening in mainland in Hong Kong tech versus what's happening in Korea, and perhaps some analysts are saying that there is still some room for Hong Kong tech to continue gaining. Right, it's a bit late to this AI rally, and perhaps still some legs there for that to go. HSBC down by 1.5%. I believe 1% or 1.5? Yes, 1.5%. And yes, this is the story about that banking regulatory crackdown, especially affecting some of those cross-border investments when it comes to high net worth individuals that are banking with HSBC. Dollar yuan pretty flat at 677 per dollar, and the yuan continues to be this safe haven currency, at least in Asia, against this backdrop where you have a lot of these EM currencies under pressure today. Take a look at some of the movers that we're watching in China. Let's see how the Chinese chip stocks are doing. And yes, it is tracking what we are seeing in Korea, right? Big drops here when it comes to Hua Hong, SMIC, some of the chip equipment makers like Nomura Technology as well, seeing declines of about 3 to 4%. The Infotech index also down by 3%. And also a quick check at some of these Korean ETFs traded in Hong Kong, the leverage ETFs. This has been the major driver. Down by 15% for SK Hynix. This is what's driving the volatility that we're seeing on the Korean Kospi today, right? Huge leverage ETF that is unwinding right now.
Yeah, these single name ETFs, right? That is shaking up the broader markets in some ways. So that you continue to see that volatility there and that unwind of double digits losses here. The inflation numbers out of the Philippines was better than expected, but we're still talking about a 6.8% print. So still elevated, although you are seeing a bit of relief when it comes to the peak comp here as well. Banks are also doing a little bit better. But yes, they did talk a little bit more about how they're going to do more targeted measures when it comes to stabilizing prices. And the BSP has already talked about here about how they are ready to hike if they need to right now. So a bit of relief when it comes to the inflation numbers, you could say. We'll see what RBI does, right, when they do meet later on today. Expected to hold, though. But yes, Indonesian markets are just about to open the top of the hour here. And certainly that market continues to be roiled as well. Joining us now is Ken Wong, Asian equity portfolio specialist at Eastspring Investments. We talk about this unwind in Korea.
Yep.
That, it was ferocious the way up, and it seems like it's been parabolic the way down as well. Is this a dip to buy?
Opportunities.
Yeah.
The fact is that, since April 8th, we've seen a fairly strong rally. The fact is that you got to be a bit more selective. The fact overall is that semiconductors and memory has done very well. But at the same time, electronic components have, some of them have done quite well. Some of the electronic material makers, the fact is when you look at an AI server, there's a lot of other pieces that go into specifically what goes into an AI server. And so I think it's going to be important, to see kind of how you go within, let's say, even the IT index, and even specifically within the IT sector, there's a lot of sub-industries that you can invest in. So I think looking at the right opportunities is going to be important, at least over the next few weeks.
So you're saying picking other stocks aside from the heavily concentrated ones in Korea.
Correct.
What about in China? Because we are seeing some of these chip names that are really not doing as well as what we are seeing in Korea, Japan, Taiwan.
Yes.
What is driving this gap, and is there room for the Chinese tech names to catch up?
Again, a lot of those names are Asian names, right? Mm-hmm. And the fact is that they're still somewhat underrepresented. The fact is that a lot of global investors still continue, when they do like to buy semicon or memory, they focus on Korea and if there's opportunities in Taiwan, that's usually where they go to. I think this is one area that we see in the second half of the year, where specifically investors, especially if valuations are getting quite high in places like Taiwan and in Korea, especially around the semicon and memory, then some of these Chinese A-share names are also great opportunities. And more so, we're also seeing a bit of a correction in sector rotation, where not necessarily we're seeing people going into IT over the last week and more into TMTs. Right? The fact is that the TMT sector has been underappreciated at least over the last 8 to 12 months. The fact is that they have underperformed quite significantly. I say that this is also a good opportunity for those investors looking to buy some of those names, specifically at a much more attractive valuations today.
You're underweighting Taiwan, though. What's the reasoning behind
so that's within our tech sector specific portfolio. So in particular, Taiwan, you have a very couple of the large heavyweights. And then thereafter, there's a lot of the other smaller component makers. So because if you're not having large exposures to a couple of the larger names, this is also a very good representation as to why we would have a slight underweight. And this is also why we're overweighting China. It is those China A-share names, those specifically hardware providers, that has not, hasn't seen the love. I would say that, some of their Korean counterparts or Taiwan counterparts have had.
I think our team was speaking to some traders, and you're saying the biggest trade in Asia now is to sell Indonesia. What's your outlook on EM equities right now?
I think overall this is a very difficult situation, because a lot of the EM equities, especially here in Asia, if this year if they didn't have any exposure towards IT, chances are overall performance would not be good. But then at the same time, with any meaningful correction, potentially you might start to see some of that flow going back into some of these EM countries that have significantly underperformed, or those specifically, who have had very little AI exposure. And, for some investors who, might be, wanting to be moving slightly a little bit off of some of these AI names, then this might be areas where they might go to. So places like Indonesia or places like India, those could be two areas where investors might start to look for some opportunities in the second half of the year.
So, the fact that we really haven't seen the inflation concerns really change the whole AI CapEx spend.
Correct.
In any ways. how long do you think we could see that sort of earnings visibility when it comes to this whole build out of AI?
The Asia suppliers are still going to benefit.
Okay.
I think this is going to be something that a lot of investors are really carefully looking at. The fact is that as long as AI CapEx continues to grow, the suppliers and the manufacturers here, whether it be in Taiwan, in South Korea, in China, in Japan, they're still going to continue to benefit. I think what's going to be more important is, in the second half of the year, with inflation, is that going to really force interest rates to go up? If they do, specifically, how is that going to impact on overall capital expenditure over the next couple of years? This is something that a lot of investors should be mindful of. So if interest rates remain at current levels, I think we're sort of in a fairly good opportunity set in terms of AI capex continue to grow at a fairly robust pace. But the concern is if interest rates do go up, then what's going to come with AI capex?
Aside from the fundamentals of these companies, which are obviously very strong, but do you think positions are a bit overheated? Some analysts are saying we could be seeing the bubble burst next year.
Valuations aren't really telling us that this is the case, right? If we look at Asian IT stocks in general, they're trading roughly around 30 times earnings. Okay. U.S. IT stocks are trading more closer to 40 plus times earnings. So yes, they are getting more expensive compared to where they were, let's say, 6 months ago. But if we look at if earnings continue to grow, and we've seen constantly positive earnings revisions in places like South Korea, in Taiwan, even in China A-share space with the tech names. So as long as earnings continue to grow at a fairly robust pace, there isn't really a reason why, sort of people should be concerned about, overall, is PE valuations getting a bit high? We are higher relative to where we were 6 months ago. But of course, if earnings continue to grow at a robust pace, we think that there's still opportunities.
Is there a trade that balances all this? People look at income, people look at value. Is there room in a portfolio to still have some protection?
Definitely, right? We always talk about diversification, right? Diversification is always going to be important. So the growth trade has done very well. EM Asia, especially when you look at kind of the North EM Asia, has done very well this year around growth. But then let's say if people do start to rotate out, and people start to look more at fundamentals again, this is really where the value, the income trades do come back. And this is also why we talk to investors all the time, say you can't only be in growth. You need to be diversified, have a bit of income, have a bit of value.
Where is the best income play now in Asia, you think?
There's a lot of different areas. Right? Within financials, there's utilities plays. There's still a lot of countries. Every single Asian country still have a lot of income opportunities. China, here in Hong Kong, there's plenty of stocks which are still paying fairly good income, especially if you think things might cool down slightly. So then that's where people want to maybe have a bit more of an income. And then of course value, right? The fact is that growth can only outperform for so long, and then there's sometimes is a bit of a correction, and then that's really when value stocks starts to outperform.
Ken, thank you so much. Pleasure to have you on our show. Ken Wong, that was the Asia Equity Portfolio Specialist at Eastspring Investments. Coming up, more on China's unprecedented cross-border trading crackdown and the fallout for banks and insurers in Hong Kong. Analysis next with Bloomberg Intelligence. This is The China Show. All right, quick look at some of these banking and financial stocks in Hong Kong, and most of them are traded lower today, down about 4% when it comes to Prudential. And this is really because of that cross-border crackdown when it comes to outbound investments by individuals. And that is hitting some of the cross-border investment, especially for high net worth individuals when it comes to the wealth management business for companies like HSBC, for example. Sources saying that the bank is now suspending bank accounts held by mainland Chinese clients. And the same thing for AIA and Prudential, right? They get about a fifth of their clients from mainland Chinese travelers buying into those insurance.
Yeah, let's bring in our team and get more on the impact on what this means. Bloomberg Intelligence senior analyst for banking and fintech, Francis Chen, is with us, along with, of course, our insurance analyst for Asia, Stephen Lam. Francis, I'll start with you. Wealth management, I mean, it's clearly the growth engine for both banks like HSBC and Stanchart. But break down the numbers for us. Just how heavily reliant are they on Asia, and specifically when it comes to Hong Kong and China?
We just take HSBC as an example. It has about 1.6 trillion US dollars of wealth balance at the end of last year. In fact, 2/3 of them comes from Asia. And I'm sure more than half of them should be generated from Hong Kong, given Hong Kong is its largest wealth hub. And if we take a look of the new money flowing into the wealth balance, it reached 86 billion US dollars for last year. And I reckon maybe the portion from this region or even Hong Kong could be 60-70% at least, based on their announcement or the disclosure. For Standard Chartered, we see very, very similar trends. They have $450 billion of wealth balance, or the AUM under their wealth management business, and they generate 50 billion, new money, new inflow to the group, and I think 50% plus could be coming from Asia and Hong Kong, China.
Francis, so given that both banks saw wealth revenue surging by over 20% last year, will this new scrutiny put a sudden brake on that momentum?
That would be a twofold question, I reckon. In fact, if we look at the wealth fees, as far as I know, or how the industry has understood, much of the wealth fees coming from transactions, new purchases of products. In fact, the existing client pool contribute almost most of those fees, at the very least in 2025 and first quarter. And you're talking about the new accounts. Yes, in long term, it helps the accumulation of wealth balance or deposit balance for the banks. But if you talk about really, really near-term or mid-term impact, we are talking about the 1.6 trillion of wealth balance for HSBC as a group. They have already got a huge base to have the circulation of new products to the existing clients. I do expect a tiny bit of a slowdown for their wealth income, but I don't think it may be significant. And you can take reference to how the investors are viewing this. Yep.
Stephen, for the insurance read-through, I mean, we saw what happened with the stock of AIA, Prudential. I mean, these are insurance companies that rely on a lot of mainland investors to come here to Hong Kong to buy insurance products.
That's
What
right.
impact do you see?
Yeah, I think clearly it's naive to say that there's zero impact to these companies, but I think we need to put things into perspective, right? So a few points I want to point out. Number one is it's not that we have not seen that before, right? Way back in 10 odd years ago, we already have this clampdown on Union Pay, right, swiping cards, and we have this $50,000 limit. So that's point number one. Point number two, I think it's very important, is that the insurance products are very different from these sort of investment vehicles that, the private wealth management or the trading accounts that we're talking about. These are really sort of life insurance, health insurance protection. It's not for speculation, right? So I think regulators will need to have that mindset in terms of what they're barring, people. So I don't think it's very clear that they're not barring people from buying insurance policies. What these sort of narrative have created is eventually a little bit of a choke point in terms of the capital flow, because you still need money to purchase these policies, right? So, but I think the broader question is, we can throw some numbers out here, right? Let's say 20% of the MCV business impact to AIA, Prudential, and whatnot. Now, that is only that part of the segment, right? But AIA, Prudential, and the other life insurance companies operate regionally. So if money doesn't come to Hong Kong, it will go somewhere else.
Go to Singapore, is it?
It may go to Singapore, right? And these guys also have mainland China business onshore. So if people are not buying in Hong Kong, where do they buy, right? So that's another point. So last but not the least, I think, I don't want to sound too optimistic, but these money that are banned from Futu and Tiger, right? These are sizable money.
Yeah.
If they're not doing, stock investments, what is the next sort of pecking order? I think people can sort of figure it out, by themselves in terms of. But I can give you the size and scope, right?
Sure.
These amount, I think there's a big number being thrown out, say $40 billion.
Yeah.
Okay. If you put that into perspective of the Hong Kong new premiums, that's already like 80% of that.
Yeah.
Of course, not all of that, right? But a fraction of it may come down. So I think in totality, there will be some sort of knee-jerk reaction in terms of investor sentiment, but I think we really need to, go with what's actually really happening. So the capital flow, it is a concern, I have to say, but a lot of the high net worth money are already outside of China, based on my understanding. Yeah.
Francis, I mean, we talked about the knee-jerk reaction. We're continuing that for another day across some of these banking stocks. HSBC, AIA are falling once again. How do you think investors are reading this? Do you think it's mostly priced in, or is there more pain ahead?
Well, I think yesterday in the London trading session, HSBC and Standard Chartered stocks, they have been down 5 to 6%. So what you're seeing now, at the very least, we see the share losses, they narrow. I suspect more and more investors, they might come to the conclusion, as I explained earlier, much of the wealth fees, the incremental growth could be coming from existing portfolio, existing client pool. Although in long term, more should be welcome from new accounts opening for mainland investors or mainland depositors. But in short term or in even mid term, we have accumulated a mass of wealth balance for these banks to continue growing their wealth business. I think my point would be very similar to Stephen's, and we should not be too pessimistic, at least from the wealth management business point of view.
Gents, thank you. That was Francis Chen there, our Bloomberg Intelligence senior analyst for banking and fintech, as well as Stephen Lam, Bloomberg Intelligence's Asia Pacific insurance analyst. And it's perfect timing that we're having Bloomberg Invest, right? We're going to look closer at the future of Hong Kong as a financial hub and China's gateway to international markets. Next week at Bloomberg Invest Hong Kong, we'll be speaking to Financial Secretary Paul Chen, Hong Kong Exchange's CEO Bonnie Chan, and the CFOs of Baidu and Lenovo. But before that, you don't want to miss the China Show on Monday. We got a special episode that we're drumming up for you. Cross collab with the China Show, and the Odd Lots host, Tracy Alloway and Joe Weisenthal, will be here in Hong Kong with us on the show. You don't want to miss that one. This is Bloomberg.
guess we are kind of like AI in a very surreal environment. Frankly, I don't think about it. No, it's hard not to, but no, just focus on fundamentals, create value, and stop thinking about your stock price. Trouble is very hard to do that.
That was the Broadcom CEO Hock Tan speaking exclusively at the Bloomberg Tech Summit in San Francisco. And let's take a look at some of the Broadcom suppliers here in Asia after the overnight slide of about 12% or so when it comes to Broadcom in the US session. But here, TSMC and some of these suppliers here largely seeing some downsides here. And especially it's also showing up when it comes to the big tech stocks in Korea, right? Like Samsung and SK Hynix as well, Yvonne.
Yeah, so obviously that side of this Broadcom story, but then you take a look at what's getting hammered. It's really going to be the broader chip sector here today. Take a look at what's going on in Korea and the like. We're going to kind of look a little bit more outward here and look at Lululemon suppliers in Asia. After the company did cut its outlook, they're adding pressure to, of course, the incoming CEO. So they lowered the annual forecast because of deteriorating performance when it comes to North America. So some of them are lower here this morning. Broad markets in China looking like this here. Broadly speaking, relatively looking a bit better than the rest of Asia here today. CSI 300 now back in positive territory. Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. Sunny skies in Shanghai here today. It seems like we are now back to, better territory. We're back above water when it comes to that benchmark here. We're flat when it comes to MSCI China as well. But relatively speaking, doing a little bit better, right? But if you look under the hood and you see, there is quite a bit of rotation that's going on across these markets, right? When you talk about what's going on with these even AI pure plays as well, even those are getting smacked here this morning, like Minimax, Zhipu, which have been the favorites, of course, in the AI trade in China. Minimax is down close to 9.5% and really kind of following some of the fallout from we're seeing when it comes to the chip makers in Korea, which is dragging the Kospi lower here today. So SK Hynix is down another 6.5%. The Broadcom story certainly has another day, another headwind for Asia side of things here. So that's what you're seeing here today. You add that to, of course, what we're seeing across the financials, where, the rest of the world, actually, you are seeing these cyclical plays play out. And actually, banks are doing quite well, with the exception of what you're seeing in Hong Kong, given this regulatory scrutiny when it comes to mainland investors' offshore investments. So that's continuing to hurt the likes of HSBC, some of the insurance plays here in Hong Kong today. Here's what EM is looking like across Asia. So Indonesia continued to be under a bit of pressure, although marginal losses at the get-go here. Of course, we're watching very closely their currencies. Look at the PCOMP, though. Seems to be a bit of relief on those inflation numbers after they came out much weaker than expected, right? But still, a punchy 6.8%. So we'll see what the BSP is looking at when it comes to future rate hikes and the like. But you're starting to see, look at the Korean won, continues to be the underperformer here and weakening now more than 1%. We're at that 1,550 level for the dollar won. So certainly it seems like this fall that we're seeing, this unwind that we're seeing in some of these chip plays, that continues to roil really the currency here this morning. Renminbi seems to be pretty solid here. 160 still levels around dollar yen. And yes, we're back to around that 18,000 level when it comes to the rupiah. So that is still, I think, near or at record lows right now. PCOMP actually is gaining. I should say when it comes to the peso is actually gaining here this morning as well. So certainly there's still that intervention risk that we're seeing across EMFX, given just what we've been seeing, the trajectories of all these currencies with the yen, the won, the rupiah, and the rupee. Keep in mind, RBI is also expected to come out with a decision later on today as well. Expected to hold, given that inflation is still okay in that economy, but looking for commentary on what they're going to say about the currency in particular. Let's bring in our team now. Chief Correspondent for FX and Rates in Asia, Ruth Carson, joining us from Singapore. And we have Anthony Stevens. He's still with us here in Hong Kong. Anthony, I'll start with you. I mean, we see the unwind in Korea. FX continues to be roiled. I mean, what really is kind of top of mind for you on how long this kind of unfolds?
Yeah, like the cyclical rotation that we saw in the U.S. doesn't really benefit us in Asia to quite the same extent.
Yeah.
You see Korea is the banks and the insurers are actually very strong in Korea, but that doesn't help the index with tech such a big part of the index. Same thing you see in Taiwan. Tech is weak, banks are strong, but net the index is weak. Japan and China are slightly different, where the banking sector is strong enough and as big a part of the index to help things overall. So you see the topics is almost flat, and as you touched on, CSI 300 is flat, helped by the strength of the mega banks. So we are going into this period where index moves are going to be like kind of contingent on sector rotation. And that's a dynamic investors have to really get used to. Now, on a macro perspective, Asian FX is starting to bleed into concern in the equity space. So the Korean won is becoming a real concern, because if you net out in US dollars, the Korean market is down anywhere from 5 to 8% at the lows today. So the FX is becoming a much more punchy part of your equity returns. The Chinese do not have this problem because it is the strongest, most solid FX in the emerging market space.
Explain to me again about what's going on in Korea, because this unwind that we're seeing is quite violent. What is it really that hard to hedge right now when it comes to this market?
The dollar notionals have to be put into context, right? Over a period of a couple of months, Korean leveraged ETFs have become amongst the biggest ETF products in history, right? And certainly amongst the biggest leveraged single name ETFs ever created. Now, the notionals that need to be hedged, if you have double or triple the returns of a 4 or 5% move, those things are massive. And they're starting to bleed into the options market as these products look for protection. That is crowding out anybody else's ability to protect themselves. So Korea faces what is called a short gamma gap on the way down. There's no one that is going to buy if there is an unwind sell. And we did see some of that messiness right on open, right? You saw the market just gap and go down 7. Now we're starting to see a bit more rationality. But Korea is definitely going to get more messy as time goes by.
Ruth, I'm going to get you and talk a little bit more about Indonesia, because we're still talking about 18,000 for the rupiah here right now. There seems to be this theme of sell Indonesia, which is becoming more of a popular strategy across some trading desks. What are you hearing about further rupiah weakness from here?
Yeah, absolutely. Take your pick, whether it's the rupiah, Indonesian stocks, or even bonds. You're seeing pressure everywhere, but definitely the clearest indication of investor anxiety when it comes to investing in Indonesia is coming up in the rupiah. We are seeing dollar rupiah at about 18,000. But if we look at what options markets are signaling, where do you catch a falling knife? Options traders are assigning around a 40% chance that dollar rupiah would trade at 19,000 by December. Push it out to a year, 20,000 per dollar is possible. So definitely a lot of pressure here in Indonesia, most acutely in the rupiah.
And tell us about, there's so many different challenges that are happening in this market. How big a role does politics play in all this? And really the current Prabowo administration's policies have a play here in really denting the sentiment?
Yeah, absolutely. When it comes to investing in any emerging market, politics often play a big role. Can you, fully have confidence in a particular administration's policy? Now, in Indonesia's case, we have seen investors increasingly worried about everything from, growth targets through to also things like, for example, transparency. And it's also not helping when it comes to, communication, but also what index providers like MSCI have done in terms of, warnings about the status of the nation's stocks, or in fact also on the sovereign rating side. So it is a cocktail of factors. Politics definitely weighs in a big way when it comes to denting that investor sentiment on investing in Indonesia.
Yeah, at least today the JCI is doing a little bit better, but certainly continue to watch what happens with the currency. Thanks, Ruth, our chief correspondent for FX and rates in Asia, Ruth Carson. Also, thanks to our markets reporter, Anthony Stevens there. We're also looking ahead to, of course, that rate decision coming through from India later on. The RBI widely expected to retain, of course, that neutral stance and really holding that rate at 5.25%. Inflation does remain below that 4% target for now for the central bank. It is, though, beginning to pick up when it comes to higher fuel and food prices, of course, due to this Iran war. We also talk about the currency, right? That's going to be very much in focus here. It's really hit record lows since this war began. We have some lines crossing here when it comes to President Xi Jinping. So it seems to be confirmed now that the Chinese president is going to be visiting North Korea in a few days, June 8th to 9th, for the first time since 2019. So that date has been confirmed here. Of course, this is after, of course, China opened the welcome sort of mat, I guess you could say, for President Trump. A lot of leaders that have come in and out of China here. And of course, we are talking a little bit more about the Russian president, Vladimir Putin, that also went to Beijing shortly after Trump was there. And the next stop seems to be for President Xi to speak with Kim Jong-un. So certainly we'll see what happens and what comes out over the weekend from that meeting. Coming up, we're going to hear why BOC International sees a return of broad macroeconomic confidence in China. The chief strategist, Chen Haofei, joins us next. This is Bloomberg. All right, checking markets in Hong Kong as well as in China here today, and we are seeing the CSI 300 actually seeing a bit of a bright spot here. So we're seeing gains about 0.1% in Shanghai. It's not much, but this is really against what the grain here, where we are seeing continued unwind in Korea. Although we're off some of the initial lows in the Kospi, Hang Seng is also marginally lower here this morning, and the currency, has been pretty steady of late, 677.48 here this morning. Let's bring in Chen Haofei, chief strategist and head of research at BOC International. I want to get the title from your mid-2026 strategy report. Okay. Acceleration post-inflection to steady throttle on entry. I don't know what that means. Can you explain to me?
It's like a metaphor. We are thinking about the China economy like driving a car. Right? When you want to turn the direction, you need to slow down first. And then when you try to change your direction, you may push your gas a little bit. Right? And then when you're on the right track, you may try to keep the steady throttle instead of keep on acceleration. That's the idea. That's why in the very beginning of this year, we believe the CPI, PPI turnaround will be earlier than expected. At that time, a lot of expectation believes the inflation turnaround will be in second half next year, which is still far away.
Then the Iran war happened.
Then people say, okay, it's imported inflation. So our point is, first of all, based on our analysis, the imported one accounts for less than 20%. It's just like a trigger. Like in Japan, the imported inflation is a very good trigger, right? And then the unified national market, the try to curb the homogeneous fierce competition actually makes a large part of the reasons. As well as the government, the policy makers this year decide to support specific industries. So that may also help the inflation turn around a little bit. So why inflation is so important? Because that changes people's sentiments a lot. So in terms of that, we say even imported inflation is good. Because
it's narrow.
Also,
it seems to be a very K-shaped economy, right? Where you start to see exports and this whole AI boom is helping this engine. But consumption remains weak in some ways. Can this K-shaped economy continue, even if reflation is quite narrow right now?
We think the K-shape is good because that helps to facilitate the allocation of the resources, right? And I would say this year, the second observation we want to highlight is the government is scaled back a little bit to the direct consumption subsidies, right? Because consumption subsidies, the value chain is short. The multiples is not that large. So the government, if they spend $1 to subsidize into the new economy, the multiplier effect will be much, much larger. So we need to be patient and wait for the transmission, the feed into consumptions instead of directly.
Wealth effect to consumption, you think?
Wealth effect, income effect, that may take time. So the K-shape will last a little bit longer. Whether it would narrow, we don't think that will be the major concern for us, as well as we believe for the decision makers. So we believe we need a patient, we need to have confidence, and then we need the feed up the pass-through, the transmission effect that takes time.
Do you see any signs of this, export boom related to AI, losing steam in any way, or do you think that this has some runway?
I think that's a very long runway.
Yeah.
I used to be actually a TMT analyst.
So you're the
kind of lucky,
yeah.
When the telecom is the best sector, I was a telecom analyst. And then they got internet.
Yeah.
Then suddenly I cover BAT. So 6 stocks I cover accounts for maybe 90% of the trading volume every year. So my experience is like all the upward trend takes 10, 20 years, right? But now this AI trend, I think, is more profound. It's definitely more profound. But it lasts like how many years?
Yeah.
At most 5 years, right?
Yeah.
And then the funny thing is when we're looking into the telecom bubble or the so-called internet bubble, at the very end of the bubble, you will see like 1 or 2 years, no correction.
Yeah.
While for this AI, every year we have 2 corrections. Every year, one correction we call like a medium-sized correction, about like 10%. The other is like 20%. Okay. Very, very big, like we call it pullback for entry, right? But every time you hesitate, you do the entry, and they'll ask, when is the next time for the pullback?
Yeah.
So I would say it's definitely very, very far away from the so-called like bubble or whatever. It's still far away.
There's a bit of dispersion, right? When you take a look at the AI cycle in China, where the hyperscalers, although they have the full stack, they have the ecosystem with 1 billion users. The investors are not quite tilting towards these names. It's more the independents, right? Can that divergence continue, you think? Right. The outperformance in terms of the mini-maxes, the Zhipus, and the AI pure plays?
I would say there's 2 kinds of dispersions. The first is old economy versus new economy, right? So that's why in the first quarter this year, the results shows the new economy-related industries registered about like 22%.
Yeah.
We are lucky to right on the top in our 4-year forecast. So its run rate is very healthy. For the old economy sectors, still grow 8% YOY. Yeah. So this is the first time we see earnings increase in the last 3 years. But there's a dispersion, right? But whether will old economy catch up, because of you said the consumption is slow, properties is slow. In the first 3 days of this week, we see property numbers is not that good, even in Shanghai, right? And the retail is sluggish as well.
Yeah.
So we don't think that gap will converge. Okay. And then the second divergence is, as you said, we have like Tencent, we have Alibaba, whatever, right? These are tech names, they have AIDC, they have models as well. But why their stock price is sluggish? Whether that kind of convergence will happen.
Yeah.
What we believe is for some names, we do expect.
There's a narrative that some of these AI plays in China are it's harder to make money compared to the U.S. What's the other side of that? You're saying that earnings is actually
it's not the case, because when I first covered telecom, China telecom market cap is only 5% of the U.S. peers. Then we joke, well, in our career life, whether we will see it counts for 15, 20% of the peers in U.S., then 10 years, the gap disappear. And sometimes even we surpass them, right? And when I covered internet, the same case, 5% of the market cap, and then in 2016, catch up, right? So the reason is we have similar GDP size. So why our total market cap can only be 10% of the peers? So it's not the case. So it's just because our development stage is different. Just like 20 years ago, when you look at the U.S. tech stocks, they're not ranked as top.
Where can that market cap be then, you think?
20 years?
Yeah.
We actually did a research.
Oh,
every 10 years.
Yeah.
Rank the top 100 stocks. Yeah. See which sectors they are in.
Okay.
20 years ago, nothing of this today's top tech names is there.
Yeah.
No one.
It's great stuff. Haofei, it's great to have you. Come back, please. So that was Chen Haofei there, Chief Strategist and Head of Research at BOC International. We got plenty more ahead. This is Bloomberg. Well, Broadcom CEO says the company he created using acquisitions now sees deal-making as a distraction. We spoke exclusively to Hock Tan at the Bloomberg Tech Conference in San Francisco and asked him whether the AI boom means there's no longer any need to use M&A for growth.
And it's an interesting question. It's a very valid question because it crosses my mind and that of my board on an ongoing basis, not regularly, as do we do M&A. So I'll be very flip and give you a straight answer. In the last 2 years, between 24 and 26 this year, I would be doubling my revenues. I would create over $50 billion per year, annualized, on revenue. I'm looking around, what can I buy? They even come close to that. And that's the tricky part. I mean, it's a distraction. All M&As are distraction to acquire, go to regulators, a further distraction to integrate. Another year. Meanwhile, organically, this phenomenon we call generative AI and our ability to ship them picks and shovels, the compute capacity into this demand, which is almost insatiable, makes it very hard to choose M&A over focusing and succeeding in generative AI compute.
Is there any area where you think you might want to sort of make an exception to this, whether it's maybe photonics, just to name one area?
Photonics? Or you mean optics?
I'm just throwing
anything.
Out... Yeah.
I ran a business model 20 years. I tried to, very hard, I know, try to avoid bright, shiny objects.
All right. I want to ask you some of the same questions that I've asked some of the other keynote speakers about, when you look at the price sensitivity around token usage and the price sensitivity around, when businesses are prioritizing spending on this. We've seen a lot of companies start to kind of cut back on throttling use of tokens, et cetera, as we talked about earlier. We've also seen indications that certain Chinese large language models are starting to gain a lot of traction, particularly given how efficient they can run, whether it's DeepSeek, the list goes, Alibaba's Qwen. Are you seeing that at all from your vantage point?
From what I've heard, I can't say we're doing it here in Broadcom, but what I've heard a lot of, and I assume you hear from the same source, a lot of company leaders, CIOs of companies talking about, hey, we're trying to find ways to reduce token costs and all that. And maybe they are ahead of the game where we are. But my sense of enterprise usage of AI, we're still at the early innings of this game. And I think we're still trying to learn what we can get out of this phenomenal tool that we have created and continue to enhance and improve with each succeeding generation. So from my personal viewpoint, as I said earlier, and from my experience running at Broadcom, I don't want my guys to go nuts overspending on tokens. But on the other side, if you can create value out of it, and that you have a return on investment that you otherwise could not, why stop?
So that was Broadcom CEO Hock Tan speaking exclusively to Tom Giles there at the Bloomberg Tech Summit. Interesting enough, before that conversation, right, we did see the Broadcom stock actually fall some double digits. So I think it was like about 12 to 13% overnight here. So that's really kind of playing out on some of these chip plays across the region here. SK Hynix is down some 5, Samsung's down 2, Tokyo Electron seeing more pain here of 6% downside. So that continues on here today, of course. And we're also seeing a bit more rotation back into some of even the China tech tech plays, like some of the big sort of hyperscalers are actually doing better. But then look at what we're seeing when it comes to some of these AI pure plays. Some of the winners before now seem to be continuing on and seeing a bit of an unwind here. So Minimax is down 8.5%, Jupo is down close to 7%, and Lenovo is also seeing downside about close to 5% here today. HS Tech is mostly lower here today. We're down 0.8%. So we'll have much more coming up. This is Bloomberg. We are looking at Japan markets now as we count down to that lunch break at 11:29 in Tokyo here right now. So we are seeing still some sell-off there in Tokyo. We're down about 1% on the Nikkei. Topics is a bit flat here this morning, but dollar yen still a little bit on intervention watch here as well as we still hover around that 160 level. We did get that wheel rage data coming through from Japan, which did rise for a fourth month. So that does back, of course, some of these hike bets from the BOJ as well. But that's not really changing with the trajectory of the yen at this point here. But yes, that's the latest when it comes to Japan. Asian markets are doing this here across the region today. We are seeing, of course, this sell-off, but I think it looks like we've come off a little bit on some of these North Asia benchmarks as well. But we are still seeing downside about 0.9%. U.S. futures are a little bit deeper into the red here, and really unusual, at least during this time of the day in the Asia session. But yeah, you're seeing most sectors are in the red here this morning, and it really is the chip side of things and what we're seeing in infotech, which is down some 2% there on the very left side of your screen. And the financials is one thing to watch out for as well. So we did see in terms of the cyclicals in the U.S., we're actually doing better against this sort of tech sell-off, but not the financials that you're seeing in Hong Kong, right? So these concerns about cross-border curbs and what this could mean for wealthy mainland investors of them opening Hong Kong accounts and investing overseas. There were some reports of some banks suspending some of those accounts, but certainly when we talk to the analysts out there, the sell side at least says things might look a bit oversold or overblown right now, those concerns. But then again, you're seeing a second day of pretty heavy losses across some of these banking stocks. Standchart's down some 3% or more. Prudential is close to 5% losses here in the insurance space. So, aside from tech, aside from energy, of course, and aside from the financial side of things, we also have to talk about property, right? And the mainland has been among when it comes to bright spots, I guess you could say relatively speaking, but then again, we've been talking about the consumption side of things is still struggling. But we're seeing maybe some green shoots, right, as what analysts are saying. Goldman Sachs says the rally in property stocks does suggest that, this price, there is some sort of broader recovery, and they're starting to price that in. That's opposed to the bank's baseline view that Shanghai and Shenzhen will lead an inflection in the sector. Let's head to Wang, head of China real estate research at Goldman. So, we're starting to see a little bit of, I guess, a nascent recovery, particularly from the first-tier cities, Wang here. What do you think the market is pricing in right now?
Yeah, I think after, quite strong rally in the past 2 months since we put out our report, we feel that somehow the markets already go beyond the expectation that the tier one cities recovery. So we did the second round of scenario analysis by including strong tier two cities into our optimistic scenario in terms of a property price increase, similar as Shanghai and Shenzhen before the end of 2028 by 15%. And our scenario analysis suggests that the market, based on the current rally market, probably already priced in about the 15 to 17 cities price increase from just 28 cash profit creation for developers' perspective. But of course, that with that scenario, given the significance of these 17 cities in terms of contribution to GDP 1/3, contribution to retail sales 1/3, and a contribution to property sales more than half, we think that there could be further valuation multiple expansion if these 70 cities or 15, 70 cities price increase materialize.
Walk us, you talked about the 15 cities. It's interesting, right? We really have seen it in just Shanghai and Shenzhen. What are you seeing in some of the mass market recovery now? Are there indicators that you're seeing that maybe this recovery is underway there too?
Yeah, actually, according to MBS April data, apart from Shanghai, Shenzhen, and also the other tier 1 cities, we actually had 12 cities property price had a consecutive 2 months of month-over-month increase already. Shanghai obviously stand out with the 3 months price increase already. But you pointed out right that the people still worry about whether we're going to see mid-tier housing market improvement, even in tier 1 cities, given we sort of still in kind of a K-shape recovery that in Shanghai particular or Shenzhen as well, that we saw lower end market price started to increase, supported by quite high rental yield there. At the meantime, we also see high-end market stay very strong across big cities, not just Shanghai, but Shenzhen, Hangzhou, Suzhou, etc. That's also the reason why we do second round of scenario analysis. But I guess that one thing we look very closely right now is what the government or state council just announced, this 15 5-year plan for urban renewal program. And our estimate that will bring incremental 4 to 5 trillion new investment through this program versus last 5 years. And this 4 to 5 trillion, in our view, is not a small amount, even compared with the Shantytown redevelopment program back in 2015 to 2019, where we're talking about 6 trillion incremental investment. Given property FAI right now is a lot even lower than 2014 level, this 4 to 5 trillion new investment probably will bring us back the job opportunities in the traditional industries, i.e. creating more traditional jobs that help the mid-tier cities, mid-tier segment to recover more.
It's interesting. We had an analyst a few weeks ago talk about the correlations between Hong Kong's property market and China's domestic property market as well. Now that we see signs of recovery here in Hong Kong, I was going to get your take now that we're seeing maybe tighter rules on wealthy mainland people and really how they shift their cash overseas. I think a lot of these wealthy Chinese were actually coming to Hong Kong to snap up property in the first quarter. Would you think the regulatory tightening that we're seeing here, does that force a lot of mainland investors to buy property domestically? What do you see that playing out?
Yeah. Firstly, I think our Hong Kong property analysts still views that Hong Kong housing market is a multi-year housing upturn. So he didn't change his view. And his main argument is that the rally is supported by the underlying demand and supply imbalance, as well as broader positive policies on housing market. Moreover, in his estimate that based on the legitimate ways of FX cross-border money transfer, actually the likely impact will be relatively concentrated in the super high-end market, not the mass market. So I guess that's his argument. Of course, that I think historically Hong Kong, Shenzhen, and also Hong Kong with the other top-tier cities in China, they have a very close price correlation, as we highlighted in the previous reports. So I guess that the liquidity possibly could spill over a little bit more to Shenzhen. Actually, Shenzhen is the market so far. Compared with Shanghai, we actually see more upgrade demand, supporting even mid-tier level of housing market there.
Your report also talked about what a potential wealth effect from, of course, the commercial property sector and what we're seeing amongst developers, that you could actually create some sort of wealth effect and that could boost consumption. And for an investor, how do you position around this sort of consumption theme, which has largely underperformed the market now?
Yeah, of course, we're talking about still a scenario analysis in terms of these 15, 17 cities recovery. But given the importance of these high-tier cities and given the negative delta change on the consumption side, mainly concentrated in these high-tier cities, the price recovery in these cities obviously will have positive implication to the retail sales there. Our analysis show that historically, especially in 14-15 cycle, the retail sales of the rental price lagging behind the property price stabilization by about 6 months. Similar evidence can also be seen in Hong Kong market already. So we believe the recovery, a broader recovery of housing price in China big cities will bring consumption or wealth upside to the market.
Wang, we're going to leave it there. Thank you so much. Wang, their head of China real estate research at Goldman Sachs, joining us from Shanghai this morning. Here's a look at how Asian markets are doing as we head into that break here. And we continue to see downside when it comes to some of these Asian markets here today. Hang Seng is down about 0.6%, but it really continues to be pain in Seoul here. Kospi down 3%, but off some of the initial lows. This is Bloomberg. Here are some of the corporate stories we're following for you today. Bloomberg has learned that Jane Street is planning to build and finance its own data center to keep up with growing demand for computing power. Sources say the market-making firm is talking to companies in the technology, crypto, and finance industries about building a facility. Talks are still in the early stages, and the exact capacity and location of the data center are yet to be determined. Bloomberg's been told that Airbnb CEO Brian Chesky is starting an AI lab. Our sources say Chesky is in the early stages of funding the new venture and plans to focus on user interaction and design. Unlike online travel rivals Expedia and Booking, Airbnb has not partnered with OpenAI to create a plugin, and Chesky has said ChatGPT's tools are not robust enough. Now, a partner at one of the early investors in SpaceX says he's learned never to bet against Elon Musk. Trey Stevens runs defense tech startup Anduril Industries, but is also a partner at Peter Thiel's VC firm Founders Fund. He spoke to us exclusively at the Bloomberg Tech Summit in San Francisco.
We all have very different opinions on every portfolio company. We are a very debate-driven culture. I think SpaceX is kind of a unique encapsulation and a microcosm of the way that Founders Fund works, because we invested very early, like around Flight 2.
2008? Or?
It was way before my time,
okay.
Like 6 or 7 years before I joined the fund. And at that time, obviously, it would have been crazy to think about, like, the Starlink as a part of the business. And even when we made the Starlink era bets in SpaceX, it would have been very difficult to imagine how AI would have impacted, data centers in space and all these other things that are going on. And so now, you look at SpaceX and you're thinking like, wow, like what is Elon and the team working on pertaining to like getting humanity to being a Kardashev type 2 civilization? These weren't the questions we were asking when we made the original investment, where it was like, can we get a rocket into space? It's very different companies at that point.
So you have to like refresh in real time.
Constantly,
the thesis refreshes. I mean, how much does the venture capital industry need this IPO? I think what's interesting about the Founders Fund investment is not just how early it was, but when it continued, it was across several funds. It's a big moment for the LPs as well. How much are they kind of banking on this and have been waiting on this?
Well, yeah, we have SpaceX investment in almost every fund, both across our venture funds and our growth funds. So there's a ton of exposure for LPs that were with us since the very beginning, and even the ones that joined us very recently. I think the core lesson that everyone has learned from this experience is never bet against Elon. It's just a bad idea. I think getting the opportunity for people to see liquidity that they've been hanging on to for 18 plus years is a tremendous opportunity to see some of those gains and also reinvest those in whatever the next SpaceX is going to be.
That was Anduril Industries co-founder and executive chairman Trey Stevens speaking at the Bloomberg Tech Summit in San Francisco. And of course, you can rewatch that interview on the Bloomberg Video Hub. Subscribers can explore live streaming, news and interviews, all of our Bloomberg TV shows, documentaries, reporter analysis, and more. Check out at bloomberg.com/videos. Well, New York City in a frenzy after the Knicks came from behind win in the first game of the NBA Finals. The city's transit authority has painted subway stops in Knicks colors, and Mayor Zoran Mandani signed an executive order temporarily lifting children's bedtime hours. Yes, you can party all night. It's the team's first Finals appearance in 27 years. Game 2 is, of course, Friday night in San Antonio before the series shifts back to New York on Monday. And we just got that confirmation. President Trump says he will be at Madison Square Garden for that match, that game, I should say. Staying with basketball, and of course, the big news that we got this week was NBA superstar Steph Curry's deal with Li Ning, one of the biggest ever between a basketball great and a Chinese brand. Let's bring in our Bloomberg opinion columnist, Juliana Liu. She says that Curry has really the capacity and the fame and everything to take Li Ning global. She joins us now. What do we know about this deal? It's kind of vague on details, but how is this all going to play out?
Totally vague on details, Yvonne. A lot of vibes, though. I don't know if you watched the IG video that Curry dropped. There was also a social media post from Li Ning. So what it looks like, it's two kind of sports superstars getting together in a very strategic kind of deal. We don't have a lot of details. What Stephen has said is that it will involve basketball shoes, of course, but also golf. He's quite an avid golfer, and also lifestyle. So that means athletic wear that you wouldn't necessarily wear on the court when you're playing, but you would wear in daily life or even, these days to the office.
Athleisure, right?
Yeah, exactly.
I love it. I could wear that all day, even on this show if I could. You talk about the number. I mean, there's some numbers coming out. I think ESPN said it's a 10-year partnership that could be worth $400 million.
So that's really all the detail that we have. ESPN says it's $400 million over 10 years, so it breaks down to $40 million a year. Chinese media initially had a slightly lower number, but I think ESPN should be quite legit.
Yeah.
So at that level, that's roughly double what he was getting at Under Armour.
Wow.
And if you break down further into kind of Li Ning's contribution, a lot of analysts think that the $40 million is actually undershoots. Oh, did I just make that pun? Sorry.
I like it. It's perfect.
The actual cost. Yeah. If you add in other things like marketing, right? We know marketing is always very expensive. If they set up stores or outlets in China or overseas, that's all going to add up to more. It could cost Li Ning, the company, not the person, although they are very closely intertwined.
Yes, the gymnast and the...
$60 million, right? Okay. $60 million a year. And at that rate, the estimate is that Curry is going to have to move 3 million pairs of shoes.
Wow.
A year. And again, just for comparison, and to steal Klay Thompson, that was about $1 million a year over the last 10 plus years, right? So you see the scale that he would have to move.
Wow.
It is enormous. Yeah. And of course, we know that the Chinese market, retail in general, is not growing super fast. Sport is doing quite well.
Yeah.
And the bet is that he will be able to really, energize, electrify the fan base, both in China and, of course, overseas.
How much is this dependent on whether, the NBA, they're playing again in China?
Yeah, so they are starting to, right?
In Macau last year.
Yeah, they, I went to that. I think a lot of us went to that.
Yeah.
It was really fun. And they plan to be back in Macau later this year for a preseason game. So the two big Texas teams. But even when that relationship was kind of not at its best, players like Curry and others were regularly traveling to China because there's enormous demand. And every time they go, there's pandemonium because there's so much interest and so many fans in China and so much buying, of their gear, their shoes. So that relationship looks to be pretty stable. It's not what it was previously. When the NBA were playing in Shanghai and other mainland Chinese cities.
Yeah.
But it looks to be quite a stable relationship. And I don't think the two would have, signed a deal like this if that weren't the case.
Is Li Ning looking more than just Curry? I mean, are there other athletes that they're eyeing right now, you think?
Yeah, I think this is the big signature marquee sign.
Yeah.
He instantly becomes their biggest star. Li Ning himself, of course, was quite a big star, but that was quite a long time ago, right? He's kind of remembered for what he did for China back in the 80s, and he did a lot. But now, for the last 30 years, almost 40 years, he's been mainly a businessman. So Curry is his biggest star.
Yeah.
And this deal does allow him to sign other players. So what I've argued is that's what he, obviously he's got his own enormous celebrity. He's the greatest shooter in NBA history, but he also, I think, needs to be signing other people.
Yeah, and he failed to do so with Caitlin Clark.
Yeah, he didn't. The reporting was that he was really trying to he was very disappointed when that didn't happen. She went to Nike.
Yeah.
But I think that might really fire him up to try to make this deal work with Li Ning and work with his new home.
Very interesting. Juliana, it's great to have you. Thank you. Our Bloomberg opinion columnist, Juliana Liu, about really how Curry can take Li Ning global. Make sure to check out her column today. In terms of markets, this is what we're looking at here. Yeah, undershooting, I guess, as Juliana Liu has said, when it comes to this whole AI trade, right? So we are seeing a bit of unwind there. SK Hynix continue to see a lot of pressure. We're down some 6%. Samsung's down some 4% as well. So that is setting some shivers across parts of this AI trade here. And even some of the AI plays in China, right? When you talk about Minimax, Jupu, Lenovo, these are the ones that really outperformed of late and really being the likes of course, the big 8 in China, right? So Lenovo's down even some 4%, and Minimax has been driving that charge. We're down about 9% for that stock as well. Consumption names in China is in focus. Obviously, we've been talking a lot about the wealth effect from property and the like here. There is that rotation, right? So if tech is selling off, maybe it's time to tilt to some of these underperforming sort of sectors like consumption. So Chow Tai Fook, for example, is up close to 2. Zhongbai Holdings, that's up some 10% here right now. And the financials, too, are not looking too good, right? When you look at what's going on with some of these banks listed in Hong Kong, HSBC, Stand Chart, and the insurers as well. We're seeing a second day of fallout here on concerns about these cross-border curbs and what this could mean for some of the banks and mainland, wealthy investors coming to Hong Kong to open and set up bank accounts here, and potentially also coming to Hong Kong to buy insurance products, right? So that's why you are seeing the lenders as well as some of the insurers continuing for another day to see declines here today. That brings us, of course, to what goes on, the broader discussion about macro risks and the like here, whether it's the inflation numbers that we got out of the Philippines earlier here was a softer print. But then again, RBI is coming up next, and they are feeling similar effects here when it comes to this energy crisis and really how RBI is going to respond to that. And, of course, weakening currencies, right? The rupee is still hovering around that 95, 96 handle. So how the governor and the RBI is going to address, of course, this dollar strength and weakness in EMFX is really going to be quite telling here. But yes, inflation is still below 4%. So perhaps in this meeting, they are likely possibly going to hold as well. At least that's what the consensus is expecting here today. But then again, right, inflation concerns remain very, very pronounced here across EMFX today. So Indonesia certainly is one thing, although Indonesia is looking a little bit better here today as well. Of course, and as we count down to next week, we talked about Bloomberg Invest that's happening here in Hong Kong. We're going to have a special episode ahead of that on the China Show next week. You see there, we have cross collaboration. We have hosts of the hit Bloomberg podcast, Odd Lots, right? Joe Weisenthal and Tracy Alloway will join me and Stephen Engel for that special episode on the China Show on Monday at 9 a.m. They're pretty stoked. We're going to talk all things China, what they're going to talk about during the conference as well. Our team is going to be at Bloomberg Invest Hong Kong as well. That's happening later on next week. We're hearing a plethora of guests there. That's it for us here at the China Show. Have a great weekend.